gold and silver got oversold for the first time in a year or over a year. We marked bottom. Gold got down to literally 4,000, and silver got down to about $61. I do believe I called bottom on both gold and silver, and I did post on posted early in the week where you can see the MACDs got got very deep into sold territory, and they have now, as of a couple days ago, but today confirmed it. They've crossed over to the upside. Doesn't I mean this is not carved in stone, but generally when you see the MACDs either cross over to the upside or roll over to the downside, you generally have 6 to 8 weeks in that direction. I believe that we will probably see in this move uh, gold at least pushing the old high, and I would think you'd see silver probably in the 90s or pushing $100. And I just want to say this: it is totally gold and silver are trading, if you want to call it wrong, because think about this. Let's say that all hell does break loose. What do you want to own? Do you really want to own a piece of paper that's issued and backed by an insolvent entity, or do you want to own real money that can and will be accepted anywhere all over the world? I mean, gold and silver should be gobbled up when things get hot, but that's not what's been happening. What's been happening, gold and silver are acting like a risk on asset as opposed to a risk off asset. And I'm just going to say that gold and silver are the ultimate risk off assets.
Well, why do you think they've been behaving the way they have?
Well, because of the paper contracts, basically. I mean, they're being controlled, they're being influenced greatly by the paper contracts. Oh, and while we're talking about paper, let's go back because the last time I was with you, we talked about the March delivery cycle, which I don't know, it's suspect to me because we had 50 million ounces in January, a non-delivery month. We had 25 million in February, another non-delivery month. And then we started March with 52 million ounces, but ended up at 42 million ounces. And I believe that is this past March was the first month in 2 or more years where what stood for delivery on day one ended up being less on the final day. For the last 2 plus years, and I'll just use the number of 100, if there were 100 ounces standing at the beginning of the month, by the end of the month, every month for 2 years plus now, it's gone to 120, 150, 200. There's always been more gained during the month. This is the first month where there was actually less standing at the end of the month. And very interesting that one day the CME actually stood, the exchange itself stood for delivery.
Hmm.
And you would have to ask why. And the only thing I can come up with is there's no way to know whether that was delivered or not. There's no way to see. So did they hide a delivery that couldn't be made? I don't know, but that's the only thing I can come up with.
How do you get a net negative like that, though? How does that make sense?
Well, what happens is you have contracts that are open at the beginning of the month and then they go away. They get sold. But what's happened for the last 2 years is you have contracts open at the beginning of the month,
Hmm.
and then there's more and more that gets piled on, or has been for the last couple of years. So every delivery month, or every month, even non-delivery months, whatever was open and open at the beginning of the month, that number increased and more stood for delivery than what the initial first notice day was. And this is the first month, like I said, in a couple of years, where there was actually less that stood for delivery than was opened on the first day.
Well, it seems like the unique qualifier of this month was the fact that we had a war with Iran. How was that a differentiator in this respect?
Well, I'll ask the question: if things go really bad, what would you rather have, physical metal or paper? And it is completely counterintuitive that when a war starts, gold and silver get sold. That has been the pattern since 1991, since the Iraq War. Gold and silver got weak after that. Gold and silver got weak after the second Iraqi
Mhm. In
war.
'03, yeah.
Uh, but prior to 1991, whenever there was any type of bad news, gold and silver got bought. I mean, go back to the Afghanistan experience. That was in the late 1970s. And gold would trade up on any type of bad news with the with you know with that with the Russia against Afghanistan. Gold historically, like up until the 1991 episode, gold historically, whenever it looked like there was bad geopolitical events happening, gold was bought. And once they figured out in 1987 that they could wag the dog with paper contracts, the contracts wagging the physical price, once they figured that out, everything has become, if you want to call it, locked down. The prices are, they learned that they can actually move and control price with paper contracts. And that's what they've done. And that's what has happened for the last 30 years. Now that will break because I guess the best way to say it is what's the value of a contract that cannot perform? The answer is zero. And COMEX and LBMA are going to become irrelevant versus the cash markets worldwide.
Yeah, so as of right now, we went from having the straight close to reopen to a degree, and now I believe it's closed back up again.
Right.
So with this kind of uncertainty involved, I mean, that's even more jet fuel, no pun intended, for the price of gold, because gold it's a crisis hedge, right? At the end of the
Correct.
day.
Correct. And the real world is going to reflect the Strait of Hormuz being closed down, call it over the next 6 months, because it's affecting supply chains. One thing that it's definitely affecting is fertilizer, nitrates. It's going to be a problem for this year's planting and this year's harvest. So by the end of summer, you're going to find out that not as many crops were grown. There's less food and higher prices. It's going to be inflationary, and there's just no way that you could say that. Well, it's inflationary, so that's bad for gold. That's just complete bullshit.
Mhm. And that's even if things go back to normal or as normal as things can go right now. The cake has already been baked to a degree, right? Given the fact that we have seen 40 days of inaction within the strait.
You're looking at it from a micro standpoint. If you look at it from a macro standpoint, the cake was baked years ago, meaning the debt that's outstanding cannot be paid all over the world. There's more debt outstanding than there is money available to pay for it. And there's more debt outstanding than there is cash flow from the real economy that's able to pay for it, pay the debt service. So, yes, the cake is baked, but in a macro sense.
Right. You can make the case that's also accelerated things a lot faster. You mentioned food shortages. Should people start getting prepared for food shortages right now, even if they are in America, which is somewhat insulated from the rest of the world?
You should have started preparing for food shortages long ago, because that's where this all will end up.
Hmm. So you think we'll even be hit here in America?
Oh, absolutely. Well, Danny, uh, the financial system is a train wreck. The financial system is going to come down. The powers that be, and we'll go back to the Great Taking, have put laws on the books all over the Western world that say if your institution goes down, your money that's in the bank is not a deposit, it's a loan. Your money that's with your broker and you're holding stocks, those stocks are on your broker's balance sheet, not yours. Why have all these laws been put into place? They've been put into place because they're going to use them. And you're asking, will food be a problem? Well, yeah, I think if banks shut down and brokers shut down and markets close and you've got cascading defaults, yeah, food's going to become scarce. Food's going to become, uh, to quote the people that say you can't eat gold and silver, they're going to become the number one thing that people want. Now, there will be people that have additional, extra food that you will be able to barter with or barter for with silver. But yeah, food is going to become a problem, even in the United States, and maybe especially in the United States, because our financial system is the most levered of all.
Could the
And
go ahead.
and one other thing, and our people are the most, uh, if you want to call it privileged. Most people think, oh, it could happen all over the world, but it can't happen in the United States. So the shock value that's going to hit the population is going to be unbelievable.
Oh yeah, we're totally unprepared for what's coming. You look back during the days of the Great Depression, people were very self-sufficient. They knew how to grow
Correct.
things in their gardens. Most
Correct.
people nowadays don't even have a garden. They live in apartments. They live in these smaller homes, what have you, no backyard, no front yard.
Right.
Um, and even if you do have the land for it, people just don't have the knowledge in terms of how to grow anything.
Exactly.
So, taking it back to gold and silver and why gold and silver reacted so poorly the last 40 days, could it also be because there's these underlying liquidity issues within the system? Because you did mention all these laws being put in the books for such a case. So, could that be the case? Could that be the main reason or the only reason why gold and silver did not catch bids is because you had all these governments that had liquidity issues. Because we were looking
Right.
at, here on this channel, we look at the bond yield. The bond yields have been spiking, or it looks like they've been wanting to break out, but something's been keeping them below 5%. At least U.S. bond yields. Japanese bond yields have been spiking. European bond yields have been spiking. So, with that in view, wouldn't these governments sell gold to stabilize their currencies and debt?
Right. Well, there's no question there has been a liquidity problem. And go back to the end of January, there's no question gold and silver were due a correction. Gold had a pretty significant correction. Uh, I don't know, what would you call it? I think it was 15, 17%, but silver had almost a 50% correction. That's that's a little bit overdone. But they were due a correction. And yes, there have been liquidity problems, and a source of liquidity is you sell your winners. So yes, there has been some selling of winners. And even in silver, I mean, silver had been suppressed for so many years. People came out of the woodwork looking to sell because look, I can get over $50. I can get my money back from what I put back in, late 70s, early 80s. So gold and silver had been used as a source of funds, but in the end game, when all is said and done, gold and silver are all the funds. They're going to be all the marbles because uh, you're going to have paper currencies blowing up left and right.
Hmm. Now, if we go back to that chart we just looked at the start of the show with the MACD flipping to the upside now, and I believe you made a call for silver to around $90 to $100. What was your call for gold again?
I think gold will be back at new highs or,
New
or
highs.
at sniffing the highs, 54, $5,500.
So, with that in view, do you think that we'll ever see prices this low ever again for metals?
Uh, I don't. I think we've made bottom on this move, and I don't think we're going to come back to revisit where we are now.
Yeah. Well, it's interesting because the gold and silver trade has been moving with optimism. So, because
Right.
we got news of a ceasefire today, they moved with the market. Silver moved up to a high of 77 or
Seven.
$78. Well, what was the
Right.
high? 70, yeah, 77 and $72. Gold moved up to a high of 58.60. But then as news began to unwind about the ceasefire, both started selling off. And same thing with the overall markets. Are we in did we just witness a bull trap here, Bill, for the markets?
Very well could be. Um, the oversold does need to be worked off somewhat, so I wouldn't expect to see markets immediately turn and head down. But I think they're pretty fully valued at these levels.
Hmm.
And from a long-term standpoint, I unless we go into a hyperinflation, and that is a possibility, unless we go into a hyperinflation, I don't see uh, equities going much higher from where we are. I mean, we are going to. This is a bounce. We're going to have a bounce, uh, but I think it'll be a weak bounce.
I see. What about the price of oil? Oil sold off $20 today, or almost $20,
Right.
$117 today, down to $95 WTI crude futures.
Yeah. Again, an overbought market, a big pullback. You're probably going to see some chop here, and then what happens. What does actually happen in the Gulf? That's what's going to govern oil.
Given how things have transpired, again, we saw all these oil refineries blown up, all these oil fields blown up. Again, if things go back to normal, I mean, that's a big if. I mean, that's a low probability event as it is. But even assuming that condition, what's the price range of oil, given that we've taken so much supply offline the last month and a half?
Well, I would think just from a nerves standpoint, you're probably looking at 68 to 70 as a pretty hard bottom. And that was the top of the previous range. So, yeah, we could get back to that range, but I don't think we're going to go back into that range. And to the upside, who knows? You'd have to tell me what happens, geopolitically as to how high oil could go.
And from a demand destruction perspective, obviously these higher oil prices are not good for demand.
Correct.
Um, are we to anticipate? I mean, do you anticipate some economic and market weakness,
In oil,
just in general, because of oil's price rise?
yeah, higher oil prices act as a tax on economies. So yeah, I do think worldwide the real economy is definitely going to be lower than it would have been had there not been what's going on with the between with Iran.
How are you positioning in this environment, Bill?
I haven't moved personally. I mean, I have my core positions in physical gold and silver. I have positions in mining companies, some oil companies, and I hold all the certificates. So I'm not trading. For me, this is not an environment to trade. And the reason I think it's not an environment to trade is because you could have 100% blowing and going in one direction today and 100% blowing and going in the other direction tomorrow. So if I think you need to position for what you think the final outcome is going to look like and just sit tight. And I will say, going forward with gold and silver, I think it's foolish to try to get cute and to try to trade those because ultimately there is going to be a failure to deliver. There is going to be a point in time where you're not going to be able to buy gold nor silver for fiat. So if you sold, you made your profit in fiat and you want to get back in, but you can't get back in, how smart was that?
Yeah, it's a good point. So, I'm. It sounds like the way to go from your point of view is to position for the long term, not these short term trading events.
Exactly. And think about this, Danny. When you liquidate something, when you take a profit, you're taking a profit in fiat.
Hmm.
And I can tell you mathematically, fiat is going to go to zero.
And they tax you too.
And they tax you also, right? You've got a tax for any capital gain that you take. So the reason, or from my perspective, the original reason to take fiat and buy gold and silver is to get your capital out of the system. By taking a profit for fiat dollars or fiat euros or fiat anything, to take a profit, you're putting your money back in the system. Where is your money going to be held? It's going to be held in a money market or in treasury bills or whatever. It's back into the system. And the reason you bought gold and silver in the first place should have been to get that capital out of the system.
And
I
plus,
just,
go
it's a
ahead.
fool's game to try to trade.
And plus, with higher energy prices, you've got to figure that these prices go into the input costs of these mining stocks, these mining
Correct.
companies. And so it makes
Right.
it kind of puts it diminishes the supply, the oncoming supply of gold and silver and all these other metals too, because it becomes more costly to produce them.
Yeah, to an extent, but that's not the key. The key is that these mining companies collectively, we're already pretty close to peak production. I mean, the amount of gold and silver, I think is already peaked, and I think gold, the production year over year was up 1.5%, something like that. I mean, just take a step back, and if gold is increasing its supply by 1.5% per year, but yet fiat money supplies are growing by, call it, 7% per year. What does that tell you? There's more and more slices of the pie of fiat, and fiat is destroying its own purchasing power by creating more and more every year. And there's not, there's not a huge amount of gold that's hitting the market every year, nor silver. And in silver's case, it's already at a 400, 500 million ounce supply and demand deficit.